All right, welcome. This is Gary Parr, Editorial Director, Commercial Architecture Magazine. And this time I'm with Dale Stroud, who is the Senior Business Advisor at Uponor, Inc. in Apple Valley, Minnesota. And for those who don't know, Uponor is the leading manufacturer of PEX piping and fittings for the commercial and residential markets. Welcome, Dale. Thanks for joining us.
Thank you, Gary.
And Dale, we've talked to Dale before, and Dale has, to update people who don't know, Dale has 40 years of experience in construction-related industries and is currently involved in strategic planning, sustainability, and special project teams at Uponor. He's also the company's go-to person for market intelligence, economic tracking and analysis, and technology assessment. And it's that part of his job that brings us together today, because a highlight of my year every year is when Dale and the Uponor marketing team do an editorial tour to share with editors new developments at Uponor. And Dale is always part of the package because he delivers each year an annual economic assessment of the construction market. And always learn a lot from Dale in this presentation that he makes. So what we decided to do is get Dale together with us and have him go through his presentation, the one he's going to make to all of us editors in the business-to-business world here in another month or so. Have him do that and record it so that the commercial architecture readers can learn from Dale and really get information that will help you plan for the coming year and your proposals and what's going on in the market. So with that, Dale, we'll just turn it over to you and tell us about the business climate.
Okay, good. Thanks, Gary. Appreciate the opportunity. As Gary indicated, I'm going to kind of go through some general information and data and trends that's going on in the construction industry. Even though many of the listeners are actually more involved in the commercial construction industry, I'm first going to cover residential construction, partly because it has such a significant impact on our economy as a whole and does have some relationship with commercial construction. So we'll start with the residential sector. One of the interesting things to look at is what has happened to housing starts over the years. Actually, the U.S. Census Department started tracking, on a national basis, housing starts in 1959. So this graph shows housing starts from that start of the tracking up until the current time. But I should add that housing starts, when you hear them in the news reports and business magazines and so forth, when you hear them each month, they're reported in what's called SAR, or seasonally adjusted annualized rate. So they're portrayed each month as if they were going to happen at that rate for the entire year, and then there's also a seasonal adjustment made. An interesting thing about this graph is that a number of years ago, I attended, the first thing I wanted to mention is that over this time frame, since 1959, housing starts have averaged about 1.44 million, again on a SAR basis. Several years ago, before the recession, I attended a seminar by a noted construction economist, and he said, and these things were already starting to downturn, and he said, don't worry, housing starts never drop below 900,000, just based on history. That red line I just drew is about 900,000. So his point was, don't worry, things never drop below 900,000, and if they do hit 900,000, the recovery is like a mirror image of the downturn. So these V-shaped blips in the curve, I say the recovery is about a mirror rate of the downturn. Well, sure enough, we crashed right through 900,000 housing starts and bottomed out about 500,000. And as you can see, it's been a slow, kind of sluggish recovery to the point that we're still not back up to that historical average or that sustainable average of 1.44 million. So what this really says is there's still room for increased housing starts over the next several years to get back to a norm and kind of catch up from what we've lost. Another way to look at that is to look at a shorter term. For example, this is from 2000 to 2016. And once again, I've drawn the average housing starts of 1.44 million on this graph as well. And so for over this time frame from 2000 to 2016, if you look at what's above the average and what's below the average, here I've drawn what's above the average. So in order for us to have that average of 1.44 million over this entire time frame, the white space that's below should be filled up by the red bars if you try to average everything out. As you can see, there's a lot of white space in there between the tops of the blue bars and the bottoms of the red bars. So all that white space in there is essentially unfulfilled demand, theoretical demand for housing starts. In a sense, there's a 2.9 million unit or housing unit deficit in houses that should have been built over this time frame that haven't been built for various reasons. And we'll kind of go into that right now. One of the key questions is, where did all those home buyers go? What happened to them? It's not as if the population has declined. For example, if you go back to that first graph I showed, housing starts back when we started in 1959, where the population was about 180 million. Today it's 323 million. So it's not, population obviously has increased and we need more housing. But one of the things to look at is household formations. And, here we go. This bar chart shows average household formations for the period 2001 to 2006. You can see during that time frame, they average about 1.3 million household formations per year. And then during the recessionary period and coming out of the recessionary period, household formations average just about 550,000 per year. More recently, since 2012, the household formations have increased back up to just under 1 million. So what happened? Well, during that recessionary period, households simply weren't being formed. Children lived with parents, parents lived with children, siblings lived with siblings, roommates lived with roommates, or whatever other combinations you could come up with. So it's not as if the theoretical demand wasn't there. It's just that people weren't forming households because of the job consideration, economic considerations, etc. But now those households are beginning to form again. So demand should start picking up for housing and other, examples in the economy where household formations will drive economic growth overall. So this increasing trend in household formations is a positive sign, not just for residential construction, but for everything. Another thing to look at is, what do builders think? Well, each month, NAHB, the National Association of Housing Builders, cooperates with Wells Fargo and does what they call the Housing Market Index. And the Housing Market Index on this graph is shown in green, starting in 1995 up to the current time. And then single-family housing starts, total housing starts, are shown in the purple bar, housings in a SAR basis. And so this measurement of optimism is undertaken each month, I say by NAHB, and they survey home builders. And, they ask them about what kind of traffic you're getting through your model home, what sort of inquiries you're getting, what sort of contracts are being signed. Then they translate that into an optimism, and it's an index. And an optimism level, an HMI level of 50 is kind of the threshold between pessimism and optimism. If the HMI is above 50, as you can see on the green line, it's been above 50 now for actually a couple of years. It indicates home builders, are optimistic about the future. If you go back, you can see they were quite pessimistic when homes weren't being built for obvious reasons. By the way, that gray vertical shaded area is the official definition of the recession. So the recession was officially during the time frame shown by the gray bar. But the point is, home builders, based on what they see going on in their market, are much more optimistic than they were during the downturn. So that bodes well. Realtors are relieved as to what's going on as well. And let me explain that with this graph. One way to understand the dynamics of the housing industry is look at the number of unsold homes. And one way to look at it is to look at the inventory expressed in the number of months. In other words, how many months of inventory are available for sale that aren't sold, obviously. And so this graph shows the inventory of unsold homes, with the blue showing the number of new homes unsold, and the green showing the number of existing homes that were not sold. And again, that gray vertical bar is the recessionary period. So during the recession and shortly thereafter, the number of unsold homes was extremely high, both new and existing, which for new home construction meant, and multifamily home construction meant, you really didn't have to build that many to keep up with demand. So more recently, the demand or the inventory has fallen below that 6 months level. And 6 months is kind of the threshold where things are in balance. In other words, the number of homes that are available somewhat match the demand. That orange bar I just drew shows that the period of time when things were kind of out of sync and the inventory was above 6 months.
Yeah, Dale, that box, that's the real recession there.
Yeah, in spite of the official gray bar, we all know that the actual recession we felt as consumers and business people was far longer than that period that shows by the gray bar. And the
yeah.
construction industry in particular has taken a long time to recover coming out of that official recessionary period. One thing to look at too is, and this is not meant to be a gender issue, but just an illustration that, people have to make a decision whether they want a multifamily, say, in-build urban home or a nice home out in the suburbs. And there's been some changes in that over the last several years. And what this shows is the percentage of new homes being started, the percentage that are single family, and obviously the balance are multifamily. And historically, by that horizontal blue that I just drew, that is kind of historically single family housing has accounted for about 80% of the starts. During the recession period and shortly after, things got a little wild at times and there's a lot of fluctuation. But more recently, the number or the percentage of single family homes has settled in that mid-60 range. So what we're seeing coming out of the recovery, and at least for now, for the next couple of years, is projected that the number or the percentage of single family homes will be lower than historical average. So the multifamily segment has been, as a percentage of total, has increased. So multifamily has shown more signs of strength coming out of this recession and thereafter than single family. Although it is projected. Yes, go ahead, Gary.
Dale, unfair question here. Do you have any inkling about whether this will flip and we'll start to see single family catch up to multifamily in the next couple of years? Have you read anything or seen anything that indicates that might happen?
Yeah, we subscribe to a couple services that do forecasting, and no one really thinks it'll ever get back up to 80%, at least on a sustained basis. But there is consideration or thought, projections, that we probably won't stay down in this 65% range of single family, but may gradually move back up to 70, low 70s, but probably not back up to 80.
Okay.
Another thing to look at is this flip for flop takes between single family and multifamily is the square footage. The kind of greenish bars there, vertical bars, show the average square footage of new single family homes, and the orange bars that start in 1999, data is not available for this particular breakout prior to that, show the square footage of multifamily homes. And obviously, which as we probably can all relate to, typically multifamily homes are lower square footage than single family homes. So while there's been a 62% increase over this time frame in the size of single family homes, but that is leveling out. At the same time, currently, multifamily homes are about 58% smaller. Now, for us, I work for a raw material supplier, building product supplier. it has an impact on our business, for example, in that single or multifamily homes require less product per square foot than a single family home. So we have to, as a company like ours, and maybe some of the listeners, you have to factor this into your thinking and planning. That this change between single family and then the size differences has impact on the business. So as a quick summary, residential construction is not back up to the sustainable levels. There's this pent-up demand. The inventory is back at manageable levels, et cetera. And the general economy is also healthy. Where this higher percentage of multifamily is going to lead is unknown. Of course, one thing I didn't talk about is in many areas of the country right now, there is too little inventory of homes available. The numbers I showed earlier of slightly less than 6 months is a national average, but we know that there's areas of the country where it's very hard to find an inventory of homes that are available for sale, and it's pushing house prices up. Some other things that that are taken to consider is the labor shortage we're seeing in the industry. I'll talk about that more a bit later. The availability of developed land and so forth. So a lot of kind of puts and takes when you look at residential construction. So let's move into non-residential construction now. One thing that is a little bit interesting to think about is there's 1.2 roughly right now, about 1.2 million new housing units being built per year, and about 55,000 non-residential buildings constructed each year. So it's a tremendous imbalance. But yet the size of these two industries is not in that same dimension. And the reason for that is pretty obvious. If you think about it, this is an example of here in Minnesota. The building on the right is a new about 100,000 square foot building we constructed here on our campus, and it would take about 55 single family homes of the size that's typical in Minnesota to equal one commercial building of this scale. So the fact that commercial buildings are, again, this is obvious to all of us, take a lot more building products, and there's a lot of dollar value. In fact, this information here comes from a company called FMI. It's a construction economy firm out of Raleigh, North Carolina. By their estimates, as far as construction put in place, non-residential actually exceeds that of residential. So those roughly 55,000 buildings versus 1.2 million homes is actually accounts for more dollars total than the residential. So it's, as probably a lot of the listeners know, it's a big industry. This graph shows the relative mix of the types of buildings that are constructed for non-residential use. And as you can see, no one single market segment dominates. Yes, education, manufacturing, office, and commercial are larger than some of the others, but it's not as if there's one very, very dominant segment of the non-residential construction that dominates. You see, again, that same number, about $470 billion, according to FMI, is the annual investment in new building, non-residential building. This graph actually comes from the Census Bureau. And let's put the recession in again. And as you can see, non-residential construction put in place peaked out in right about the time the recession started, right around there, the end of 2007, 2008, and then it dropped and didn't bottom out again until early 2012. Then it's been a slow, gradual climb back up to the point that just fairly recently, last 18 months or so, where the pre-recession levels finally reattained, right there where the black arrow points. But unfortunately, the growth has kind of stalled. You can see the flattening of that green curve. So the growth in non-residential construction has slowed down somewhat compared to what it was during that recovery period. This next graph is just a single year forecast, and this comes from the American Institute of Architects, AIA. Twice a year, they collect information from different forecasting firms such as Moody's and Dodge and FMI and a couple others, and they put together a consensus forecast based on that input. And what they have determined is that based on that consensus, this is the type of growth rate that's expected just in a single year. In other words, 2018 growth compared to that of where we were this year. So you see the growth rates are rather modest, peaking out at 4.8% for education and retail, and the others being lower. In fact, religious is expected to be negative. Again, that's a one-year forecast. And overall, if you average all these out on a weighted average, it's expected to be about 3.6% growth next year compared to this year. Another way to look at that is if you look at some history and then look going forward, this is the historical put in place construction in non-residential compared with the forecast. So you can see if you look at, say, 2017 going forward, you see just modest growth rate. The previous was just 1 year growth rate. This now projects it out through 2021. So it's a continuation, a projected continuation of kind of slow, gradual growth in all of the segments, with actually education being the one that outpaces probably the others. Again, this is one company's input, FMI. There's others that may have slightly different opinions, but generally this is about where most of the forecasters think we'll be. Another way to look at it is historical versus projected growth rates. The gray bars show the growth rates that occurred between 2012 and this year in these different segments. And then the green bars show the projected growth rate from 2018 to 2021. So this slowing trend in growth, not as if we're going to go into negative, but slowing trend in growth is expected in most of these segments if FMI's assessment is accurate. So I guess the bottom line is the non-residential construction industry has recovered from recessionary levels. It saw good growth for a number of years, and now we see some slowing growth, but with only a couple exceptions. Well, actually, there's no exceptions. They all projected to see positive growth over this time frame. Another way to look at non-residential construction is what do architects think? Of course, most non-residential buildings, the larger ones at least, have architectural input. And so the AIA, the American Institute of Architects, keeps track of the billings that their AIA members make to their clients. And then they convert this into what they call the Architectural Billing Index, or the ABI. And the ABI is at a 50 is considered the demarcation between pessimism and optimism. So if the ABI is above 50, the majority of architects are seeing a positive trend in their billings. If it's below 50, they're seeing a negative trend in their billings. And of course, you want to see that positive trend. And indeed, for quite a while now, after coming out of the recession, architects have been fairly doing pretty good with their billing, as indicated by the fact that the ABI, has been above 50 for the last several years, and it's about a 9 to 12 month leading indicator. So if the ABI is above 50, you expect positive growth for at least the next 12 months. So since it's been above 50 so much, we're seeing a very positive situation with regard to architectural billings, which should then lead to improvement in the overall market. There's that pesky recession again. So what has happened in non-residential construction? We've recovered, good level activity, favorable, although not huge growth projections. The ABI is favorable, and the general economy is giving some positive momentum. Growth has slowed, and when I talk about all this stuff, I'm always talking on a national basis. And obviously there's regional and segment considerations where the numbers will vary from region and segment. One thing that affects all of our business, that the process is long. It takes obviously longer to plan, construct, and commission non-residential buildings. And again, the labor shortage, from what we hear from a lot of our customers and our own business, is rearing its ugly head. And then, of course, we have the political effects of all the different things that happen, the economy and so forth, which I'm not going to get into that subject.
Dale, that labor oh, you're going to talk about labor shortage. All right, never mind. I'll wait.
Okay. Thank you. Let's talk employment here for a second. This graph, which I started in the beginning of 2004, obviously you go back further. We classified, January of 2004 as the 0 point. The overall total employment in this country increased quite significantly, up by over 6 million, almost 7 million jobs, up through about the beginning of 2008, where you see that green line peaking out, which is again about where the recession started. Then a lot of layoffs, people lost jobs, and the overall employment dropped. Not only lost those 7 million that were gained, 7.5 million that were gained, but lost about a million more. And then employment bottomed out in early 2010. Then it's been on a slow, pretty steady recovery ever since, to the point now that we've had a cumulative increase in employment in about 16 million jobs. One thing that President Trump has talked about is adding 1 million jobs during his time in office. Indeed, there have been 1 million jobs added since his inauguration, but in actuality, we've been adding jobs at a faster rate than that since the recovery started in early 2010. Actually, we're adding about 2 million jobs per year. So that trend has continued, and hopefully it will continue on that track. The red line I showed is we actually reached back to the previous peak in the middle of 2014. I've now added, if you look just at construction jobs, that narrow purple line at the bottom, it starts at a 0 level. It increased at a much slower rate. Of course, it's a much smaller population. Then it dropped down during the recession year, and it's taken much longer to recover. It's only been within the last several months that overall construction employment is back to the level it was prior to the recession. And we hear from our customers, the builders, developers, and so forth, that one of the biggest problems they have is finding employees. We have the same problem in our own business. I just saw a report this morning, not related specifically just to construction, but the number of job openings, 6.2 million right now, is at a record level of unfilled job openings. So there's jobs available that obviously people are having trouble finding qualified employees.
So Dale, the question that I rudely interrupted you before, and now I'll do it again. So this lack of skilled labor, then, when we look at growth in the construction market, can we safely say that it is playing a role in holding back construction, that likely there will be more buildings built?
I believe so, Gary. We hear it from, we're pretty involved in the non-residential business, so we have talked to a lot of developers and big mechanical contractors and so forth, and a lot of them are having problems getting skilled labor. So I think that the lack of labor is playing a role in this maybe somewhat slow growth. So hopefully we can somehow get this corrected as an economy.
Yeah, that's a tough nut to crack there. Yeah,
it sure is. If you look at unemployment, that's actually the wrong number. It should be 4.4. I forgot to change that graph. This is the unemployment rate, with the darker red line being the unemployment rate in the economy as a whole for non-agricultural jobs. So we're back down to around 4.4%. The jagged lighter red line is the unemployment rate in the construction industry only, and it is not seasonally adjusted. That's why you see the peaks and valleys. So the employment tends to, or unemployment rate, I should say, tends to peak in the winter months and then drop in the summer months, the warmer months. And as you can see historically, if you go back before the most recent recession, the unemployment rate in the construction industry tended to bounce right across the top of the total unemployment rate. But then during the recession and after, it really skyrocketed, and a lot of unemployment took place in the construction industry, significantly more higher rate than in the rest of the industry as a whole. But as you can see more recently, the lighter red line, the construction industry unemployment has tracked back down to be closer to the national unemployment level. So that's a relatively good sign, again, assuming that we can continue to find workers to fill jobs. There's an interesting dichotomy, however. This is another graph. The black line is that unemployment rate, the one, actually same one I showed on the previous slide. But the green line then is the participation rate. It's the number of people that are eligible to be employed, or theoretically eligible to be employed, that actually want to participate as employees. And the participation rate has been dropping. So in a sense, people who could be employed are not being employed. And there's a lot of controversy and interest and so forth as to why this is happening. By the way, most of this lack of participation is happening with men, not with women. The participation rate among women is actually increasing. So more and more men are not participating in the employment market. And there's been a lot of conjecture with this is because of more men being in school, more men being in prison, more men being stay-home fathers. A lot of speculation is what's causing this, but it's a real situation that the participation rate is falling. So in theory, there should be people available to fill the vacant jobs. They're just not doing so. And it's perplexing a lot of people. And I'm not going to try to delve any further because I don't know the answer. Obviously, we as consumers have a lot of effect on the economy. And how we feel about the economy is significant. If we feel good, we spend money. We open our wallets. If we don't feel good, we don't open our wallets and spend money. So the Conference Board, as well as a couple other organizations, University of Michigan, for example, and Reuters, do what they call a Consumer Confidence Index. This happens to be the one from the Conference Board. And here, a consumer confidence level of 100 is considered that we're optimistic. If it's below 100, we've got more pessimism. Well, as you can see, in the red line being the consumer confidence plotted by month, we were pretty pessimistic, and rightfully so, when we went through that recessionary period, the official recessionary period, and then afterwards during this, what we all still feel has been a recession. And it's only been recently, the last year and a half or so, that our confidence, our general confidence in the economy has gotten back above 100, back in that area where we feel confident about what's going on. So that's, again, a positive sign that we as consumers are willing to open our wallets and participate in the growth of the economy. So that's a good thing. Again, I'll just put that in the recession. With that, I'm going to conclude my official remarks and show you a blank blue slide.
Well, Dale, thank you. That's enlightening, and certainly some bright spots. That skill shortage, labor shortage that's just an ugly thing that will not go away, and I don't see progress even in the next couple of years toward fixing that. That's problematic on several fronts.
It sure is. We are doing all sorts of things here at this company, innovative things to try to attract employees and retain employees. And we're being successful, but it's tough. We have to do a lot of unique and creative things to attract and retain employees.
Yeah, and not that far from the recession when there was so many people out of work. So it's kind of a strange thing. Yeah. All right, Dale, we sure appreciate it and enlightening information, and look forward to seeing you here coming up in November. So thank you.
Okay, thanks, Jerry.